Welcome back to the vlog. Let's just jump back into where I think we left off here. All right, disclaimer for like anyone who may actually be following along throughout the full duration of this book or any other books. Number one, I'm a slow reader. I'm a slow reader, meaning like I see people talking about reading books in like a week. I don't think I've ever finished a book in a week. I've never finished a book in 2 weeks. I probably have never finished a book in a month. So anyway, so yeah, this is not going to be like a speedy read. If we could finish this over the next 30 days or so, that would be great. But again, that would be expecting something from myself that has yet to occur in this life. So we'll see what happens. All right, so let's jump in. The divergence of price and an indicator that normally move in tandem is a wake-up call. A change in volume often predicts a change in price. The indicator is telling you something you can't see with the naked eye. Prices are putting in new highs, but not yet on higher volume, with the OBV not yet confirming new participation. Get ready to buy, but not quite yet. The term smart money refers to traders who see an opportunity forming, as in the Apple case, or the exhaustion of a price move ahead of other traders. They're alert to the movement when the crowd suddenly realizes that it has taken a price too far and reacts violently in the other direction. Truth to tell though, no indicator works all the time, and this one doesn't either. The OBV indicator was way early in calling the price drop and isn't actually leading as this chart ends. Even OBV inventor Granville famously missed a major bull market that started in 1982 and then persisted in saying it was a false bull for the next 14 years. However, periodically you can find an article online or in the magazine Technical Analysis of Stocks and Commodities, in which the author tests the OBV principle on real cases in real time, and it works spectacularly well to direct good timing. Refining volume indicators. As I note in this section, tracking on-balance volume earlier in the chapter, the OBV indicator attributes all the day's volume to buying. However, doing so isn't realistic. It makes more sense to attribute only a portion of the volume to the price rise rather than the whole kit and caboodle. A technical analyst named Mark Chaikin, hopefully I'm saying that correctly, Chaikin figured that a more representative amount would be the percentage equivalent of the price that is now above the midpoint of the day. You calculate a midpoint as the high of the day plus the low of the day divided by 2. Chaikin's version of accumulation and distribution is more refined than OBV. If a security closes above its daily midpoint, bullish sentiment ruled. The close over the midpoint defines accumulation, revealing that the investors are buying shares. The closer the closing price is to the high, the more bullish it was. If the price closed right at the high, then you say that 100% of the volume can be attributed to bullish sentiment. Conversely, distribution is the term for sellers willing to accept lower prices in order to induce buyers to buy. Lower prices imply bearish sentiment. Distribution is calculated the same way as accumulation. A close below the price midpoint means distribution. The closer the closing price is to the low, the more distribution prevailed. If the close is exactly at the midpoint, then the indicator has the same value as yesterday, and you have no reason to add or subtract volume from the running total. If you need any more convincing, consider the Mark Leibovitz that could be like a million different pronunciations. Well, author of the definitive The Trader's Book of Volume, McGraw-Hill, and website vrtrader.com, is one of those who consistently beats the market and is often in the newsletter Timer Digest Top 10. Leading the way with spikes. Volume sometimes leads prices. The most obvious situations are when volume spikes. A spike is a volume number that has doubled or more the size of volume on the preceding days, but with volume returning to normal average levels the following day. Say volume has been running 100,000 shares per day for several days, or a downtrend. This wild increase in volume means that the crowd is throwing in the towel and exiting en masse. When everyone has jumped off the bandwagon, get ready to jump back on. Nobody's left to propel the price lower. Conversely, the same advice is usually correct when you see a volume spike as the price is making new highs. The underlying principle is the same. The crowd has exhausted its supply of cash. Think about taking profit if you own the security. If you're considering a new position in a rising security that just had a volume spike, think again. Look at other indicators. Try to understand why so many people suddenly jumped on the bandwagon. Does fresh news justify the increase in demand for the security, or is it just animal spirits? A volume spike is one of the occasions when fundamental information is completely complementary to a technical observation. Beware of price making new highs coupled with a volume spike when there is no fresh news or fundamental information that attracted new buyers. Chances are that the price has gone as high as it will go. The top is in. If the security has new, legitimately exciting news and you can reasonably deduce that it attracted new buyers, you have non-technical reason to ignore the usual spike in interpretation. Getting a 2 for the price of 1 coupon. Another sentiment indicator is the relative price of the options for a specific security. The more costly a call option, the right to buy, the more you project that traders expect a price move upward. In addition, volume in options at increasing higher strike prices is a crystal clear indication that traders in this security expect it to rise. I'm going to read that again for myself. Another sentiment indicator is the relative price of the options for a specific security. The more costly a call option, the right to buy, the more you project that traders expect a price move upward. In addition, volume in options at increasing higher strike prices is a crystal clear indication the traders in this security expect it to rise. Because each option for a particular date, you also get to see the time frame over which the price change is forecast. Options are far beyond the scope of this book, but if you like the idea of confirming sentiment, go find a copy of Stock Options for Dummies by Alan R. Simon and Trading Options for Dummies by Joe Duarte. I'm assuming that's how you say that name. Duarte. John Wiley & Sons Incorporated. A terrific source is advisor John Wiley & Sons and his team. The site uses features and options as well as technical price analysis to identify and to forecast sentiment in the indices as well as individual securities. Blindsiding yourself. You may look at a price falling and volume confirming that you should exit the position to protect your capital and then not do it. Seems ridiculous, right? But it happens all the time. It even has a name. Hyperbolic discounting, meaning you see the chop coming but want to believe it will come later, not now. Behavioral economists have devised a series of terms like hyperbolic discounting to identify the myriad factors that influence an individual's decisions. The factors arise from existing cultural bias. For example, the idea that selling a company's stock short is to wish doom on it, where the American way is ever hopeful for upward progress. So shorting is anti-American. That's a lot of extra shit taken into account. Other factors are psychological and cognitive, meaning humans have peculiar ways of thinking. Some of these ways in thinking have the power to create in your mind a kind of baseline personal sentiment that is a mishmash, of contributing factors. A chief purpose of technical analysis is to remove emotion from the trading decision, but technical analysis is fighting an uphill battle against your own personal sentiment and ways of thinking. The psychologist Daniel Kahneman, Kahneman, who won the Nobel Prize in economics in 2002, writes in his book Thinking Fast and Slow that humans have two modes of thinking and decision making. The first is based almost entirely on cognitive biases, unconscious preconceptions that bypass rationality and shove a decision out the mental door quickly. In this fast thinking mode, humans give undue weight to information that is already familiar, easily available, and memorable or vivid. For example, a trend line running abnormally steeply for an abnormally long time is very rare. The trend must be nearing an end. An experienced trader may recognize from his thousands of hours of observation of previous long-running steep trends that the probability is high of a pending reversal. But it's still jumping to a conclusion and to predict a reversal without hard evidence. That doesn't mean the experienced trader is wrong. The long-running steep trend may indeed be due for a reversal, but the absence of evidence makes a trading decision to bet on a reversal an intuitive one rather than a rational one. The second slow mode of thinking is supposedly the rational, take your time mode of decision making, but it too often violates the assumption of maximization to self-interest. Experiment after experiment shows that avoiding loss is a bigger preference than making a gain. In other words, the pain perceived on making a loss is greater than the pleasure of making a profit. Traders will get jittery and exit a winning position before the chart shows any sign of a reversal, solely to avoid taking a reduction in the new and so far hypothetical gain. In addition, who you are counts. A rich person will always prefer to keep his stake than bet on a low gain at high odds, while a poor person will always take the low gain, high odds. Millionaires don't play the lottery. Very interesting. All right, so next we'll come back to understanding confirmation bias and anchoring. So yeah, cool. All right, I will see you guys next time. Thank you for joining. Try to remember that no matter what you learn from another person, whether it be a trader or someone outside of trading, no matter what it is that you listen to and that you learn, make absolute sure that you are creating your own documentation to your own trading and your own psychology. There's nothing that's more valuable than that. Like, you can follow whoever you want to follow, you can listen to whoever you want to listen to, but if you are not paying attention to what your own psychology is and making notes on that and making constant, like, daily and weekly adjustments to that, I personally do not believe that you can be successful in trading. Trading is like, in my opinion, you can have like a billion mentors, you can have your own belief system, you can have previous success, whatever the case may be. You can read a million books, but if you do not pay attention to what your own psychology is, and you don't look at how you trade, how you react in certain situations, are you greedy? Are you impulsive? Are you scared and fearful when you trade? If you don't understand these things, I personally do not believe that anyone else's successful strategy will make you a successful trader. Simply because at the end of the day, it will all fall back to your psychology. Myself personally, I have a strategy where when I trade by those exact rules and I do not go outside of them, my win rate is literally 100%. And even with having a winning strategy that is that effective, I still go outside of my trading strategy at least 50% of the time. Still, even after 2 years. Sometimes it works. Most of the time, that's when I get ate up in the market. And there's no reason for it because I already know exactly what kind of trader I am. I've observed myself, I've documented, I've done videography on myself trading. I've gone back and watched that. I've watched a number of different traders. I know what my style is. I have about 2 years experience trading in the market. I know that I'm impulsive, I'm greedy, and I'm very impatient. All of those things have improved, but they're not where I would like for them to be. And honestly, as a trader, it's like a surgeon, who's going into surgery and someone's life is on the line every single time. Every single time, your money, your livelihood is on the line. And so if you go into the market and you have the perfect strategy, but you don't have the discipline, the patience to wait for that setup to occur before you enter a trade, you will lose money and everything else in between. I like saying that because everything else in between, bro, could be fucking everything else in between. You know what I mean? Anyway, thank you for joining. I like to use this as a video diary for myself so that I understand what my progress has been as a trader. My trading success has a lot to do with like my personal development as a human being. And the longer I trade, the more I look at like the rest of life, and I see all of these correlations to the way that I trade. It's actually very interesting. So my natural impulsivity comes out in trading. It also comes out in almost every other area of my life. It's not just that one thing, it's a multitude of things. And so trading has been interesting. It's teaching me a lot, and it just, I think, continues to remind me that everything is full circle. So meaning if my disciplines lack in another area of life, it's gonna lack in trading as well. See you guys next time.